Hey guys, welcome to the first episode of the series. Today we're going to be talking about an introduction to what Forex trading is. Forex, or FX, or the foreign exchange market, is a marketplace where various national currencies are traded. That being the financial term, let's take an example in order to break it down a notch. Imagine one day you just wanted to travel to another country, let's say Russia. And you being a resident of the US or country based in the US, you booked yourself a decent luxurious hotel with that steamy jacuzzi for the late night relaxation, because who wouldn't love that, right? You planned out your whole trip in advance and you're just as ready as you can be to head over there and enjoy your time. Now, upon arrival in Russia, you realize that US dollars are not accepted. So, in order to get your hands on the local currency, you would be required to go to an exchange, right? That actually has your own currency. So, once you do that, once you head over to that exchange, you'll notice that for every $1, they provide you with 78.33 Russian rubles. Let's take that as an example. In such a case, you'd be selling your dollars and buying Russian rubles. Now you've spent your time, you've had a blast, it's time to go back home. Since you've exchanged much more than you've spent, you're left with some Russian rubles. But you won't have any use of them back home, so you'd have to switch them back to US dollars. But upon going back to that exchange, and you would want to switch your Russian rubles back to dollars, you'd realize that the exchange rate has changed. It's those changes in the exchange rates that allow you to make money in the foreign exchange market. With the digital era nowadays, anyone could search up an exchange rate on Google. They tend to come in forms of charts that track the price levels of exchanges between currencies. The charts are also formed by past price levels, pinpointing the price for every second of the day, which can also be viewed in forms of minutes, hours, weeks, and months. Because of the digital era, several countries across the world and almost every time zone participate in the trade of Forex, while multiple currencies being utilized in stocks and commodities from all participating countries being offered for trade, which is great. You can literally trade any kind of currency you want depending on the currencies offered by the broker that you open a trading account with. But because there are so many nations and time zones involved, Forex does not function as a quote unquote business day. Like the stock market, for example. Forex basically remains open for 24 hours a day, 5 days a week. Now, of course, these additional hours increase the risk factor intensity for those of us who are human and obviously cannot monitor our investments 24 hours a day. This means that the value of our holdings could potentially plummet overnight while we sleep, because other countries are still trading while we're in a dream world. Since we figured out that the market consists of currencies, the real question now is, how does the exchange rate actually move? Why does it increase or decrease? Why does it fluctuate? Well, excluding other factors, supply and demand is one of the main threats that result in market volatility and liquidity, and is mainly influenced by several key market players. So who are they and why are they involved in forex trading? Let's start off with central banks. Being the most important player, central banks represent the nation's government. With the sole purpose for fixing the price of its currency on Forex, they tend to intervene in order to stabilize their currency. So for example, if a nation's currency were to appreciate too much and would want to remain competitive in the FX, central banks would act on it by either setting interest rates or managing the money supply. Second up is commercial banks. That could range from local credit unions to investment banks. Commercial banks are market makers that tend to trade forex in order to provide liquidity for the customers and corporations. They usually do so by lending currencies with each other through electronic wiring. Next on the list is corporations. Now, companies tend to become a forex player when some of their business transactions include exporting and importing foreign goods and services. Let's consider the example of a UK-based company that manufactures cars. Most of the raw material is imported from Japan. So if the UK company would want to buy the raw material, they would have to buy them from Japan using their currency, therefore selling their pound and buying Japanese yen. But the exchange rates are always changing, they're always fluctuating. That's why companies would enter into a spot market agreement where the buyer and the seller would exchange on the current market price, or eventually set up a future contract. That is where they would agree to convert the currencies at a specified date in the future at a predetermined price. Now, we won't get into that at the moment, but the important factor here is that companies tend to be involved in the foreign exchange market in order to hedge the risk associated with the foreign currency conversions. Last but not least, we have retail traders, like us, who tend to be individuals who trade either for a living or on the side. Surprisingly, we are a huge number and make up most of the participants in Forex, but sadly enough, we make up to a very low amount of movement in the markets compared to the three factors listed before. So, why should one trade the Forex market? What are the advantages of the Forex market as compared to the stock market? Let's start off with the top of the list, which is most loved by retail traders who tend to stick to charts all day long. It's the 24-hour global market. The Forex market is open all the way from Monday to Friday, which consists of 4 different markets, each having their own working hours. That results in making up the whole day, starting all the way from Sydney, then Tokyo, then London, and finally to New York. Now, each session has its own benefits, and some might be more volatile than others. We won't get into that now, but regardless of whether it is day or night, there are always market participants actively trading in the Forex market. Forex traders can respond very quickly to any currency fluctuations or breaking news immediately, unlike the stock and future markets. Forex is known for having the most liquid market in the world. On average, there is a trading volume of $5 trillion traded per day. That's pretty huge. With the trading volume larger than all stock market combined, this will ensure price stability, which means that sellers and buyers are always available, regardless of the currency type. So if the trader wanted to buy, there is always an available seller. And if the trader wanted to sell, there is also an available buyer. The reason most people get into Forex is the low level of accessibility. Although Forex has the most liquid market in the world, it also consists of a low barrier to entry, which enables retail traders to enter the market with as little as $5 in a trading account. Now, of course, that's not recommended, but you get the point. Next up on the list is the opportunity to make money in both directions. It doesn't matter if the asset is rising or falling in price levels. Regardless of how major economies are performing, currency exchange rates are always fluctuating, and if you've done the right analysis, this in turn will provide trading opportunity for traders to gain profit. Fourth advantage of Forex is the little to no commission. You might have asked yourself, how do brokers earn their income then? Well, in Forex, brokers tend to earn their revenue through the quote-unquote spread, which is the difference between the bid and ask price. Don't get me wrong, adding extra points to a spread might impact your trading execution, of course, but in Forex you might have heard of it being very cost effective. That's due to the very low spread on currency pairs being as low as 0.4 pips. Now, you might guess that every broker offers different spreads, and that's true, so keep an eye out for it. Brokers tend to provide a list of spreads they offer, where you can find them available on their sites. Last but not least, we have volume, one of the greatest tools offered in the Forex market. We will be discussing this later on in more detail, but for now, volume is similar to borrowing money from your broker in order to trade in a larger portion. In a sense, it's down to you to decide if you would like to enable such a feature, offering you a ratio of 1 to 400 that potentially increases your buying power. Now, doing so initially increases the risk, of course, but also increases returns, so it's up to you to control your risk management. That will be all for the introduction to Forex. Next lesson we'll be discussing what is trading of Forex.